Introduction to Investments in Associates and the Equity Method. Investments in associates generally arise when an investor has significant influence over another company without obtaining control. In practice, ownership between 20% and 50% of voting shares is typically considered evidence of significant influence, although other factors such as board representation and participation in policy decisions are also important. Under both IFRS and US GAAP, such investments are normally accounted for using the equity method. Initially, the investment is recorded at cost as a non-current asset. Unlike passive financial asset investments, the equity method recognizes the economic relationship between the investor and investee by reflecting the investor's proportional share of the investee's net assets and earnings. Mechanics of the equity method. The equity method adjusts the carrying value of the investment over time to reflect changes in the investee's net assets. After acquisition, the investor recognizes its proportionate share of the investee's earnings in its own income statement, which simultaneously increases the investment account on the balance sheet. Conversely, dividends received from the investee are treated as a return of capital and reduce the carrying value of the investment rather than being recognized as dividend income. If the investee reports losses, the investor records its share of those losses, reducing both earnings and the investment account. This approach better reflects economic ownership than simple dividend-based accounting. Purchase price allocation and goodwill considerations. The purchase price of an associate rarely equals the investor's proportionate share of the investee's book value because assets and liabilities may have fair values different from their carrying amounts. Under the equity method, any excess purchase price is allocated first to identifiable assets and liabilities based on fair value. Any remaining excess is classified as goodwill. The investor must subsequently recognize additional expenses associated with these fair value adjustments, such as incremental depreciation or amortization. Importantly, these adjustments are reflected only in the investor's records and are not recorded by the investee. Consequently, the investment account represents a single-line asset that includes the investor's share of fair-valued net assets and goodwill. Impairment of investments in associates. Equity method investments must be periodically evaluated for impairment. Under US GAAP, an impairment loss is recognized when the fair value of the investment falls below its carrying value and the decline is judged to be other than temporary. The investment is then written down to fair value, and the loss is recognized in earnings. IFRS follows a different approach, requiring evidence of one or more impairment events before recognizing a loss. A major distinction is that IFRS allows impairment reversals if the recoverable amount subsequently increases, whereas US GAAP generally prohibits reversal of previously recognized impairment losses. Analysts must understand these differences when comparing firms across reporting frameworks. Transactions between investor and investee. Special accounting treatment is required for transactions between the investor and investee because significant influence may affect transaction pricing. Profits generated from such transactions are deferred until realized through use or sale to independent third parties. Transactions are classified as upstream when the investee sells to the investor and downstream when the investor sells to the investee. In both cases, the investor must eliminate its proportionate share of any unrealized profit remaining in inventory or other assets. This adjustment prevents overstatement of earnings and ensures that reported profits reflect transactions with external parties rather than transfers within economically related entities. Analytical implications of the equity method. For financial statement analysis, the equity method has important implications for profitability, leverage, and valuation metrics. Because the investor reports only a single-line investment asset and a single-line equity income figure, revenues, expenses, assets, and liabilities appear lower than under consolidation. However, the investor still recognizes its share of the investee's earnings, often resulting in stronger profit margins and return measures. Analysts should carefully assess equity income, impairment adjustments, goodwill allocations, and intercompany transaction eliminations when evaluating performance. Understanding these effects is essential for comparing firms that use different accounting methods for inter-corporate investments and for making appropriate ratio adjustments during valuation analysis.